Hello everybody. Firstly, I'd just like to welcome you to this webinar where we'll be talking about the non-farm payrolls and the opportunities its publication will present. My name is Sasha and I'm a financial analyst from the research department at Fortrade. I'm delighted to have you with us and thank you for your kind comments. If you have any questions, please call us and ask to speak to a senior account manager who will be happy to help. Before I go any further, please take a moment to read our risk warning and disclaimer. I'm sure you know that although gains can be made, trading CFDs, losses can be incurred too, and you need to be aware of this. And now let me explain what a market opportunity is, if you don't know. A market opportunity is a one-page briefing containing market analysis, and our goal is to provide you with a simple-to-understand opportunity to trade in the markets. We will select an instrument such as gold, or a currency pair, or crude oil, and tell you our very best estimate on its price direction, so that you can trade on it, if you want to. Market opportunities are produced by the research department on a daily basis according to market conditions. A market opportunity consists of fundamental analysis, geopolitical events, and technical analysis that includes a pivot point and support and resistance levels. It's important to understand it's your decision whether you want to trade on market opportunities or not. So here is an example of a recent market opportunity. Here you can see fundamental analysis on what's going on with the euro-dollar currency pair. You can see that this is a downtrend opportunity over a weekly period, since our analysis suggests the euro would decline in value against the dollar. At the top, you can see some geopolitical events and fundamental analysis that can influence the euro-dollar currency pair. For example, the part on the EU and its disagreement with the Italian government over its budget, which has put pressure on the euro. When using a market opportunity, it's vital to look at the pivot point on which the calculations are based. In this instance, if the price reaches 1.1381 that you can see on the left-hand side of the screen here, this shows the right moment in our estimation for opening a trading position, had you decided to trade on this market opportunity when it was active. You can see below the trend direction and the time period. It's also important that you know how to use the stop loss and take profit options. You have support and resistance levels further along on the right hand side of the screen. At these points you can put a stop loss and take profit. And further down you have calculations. If you close the position using take profit, you can expect these kinds of profits at the support levels in green. If the price is going against you, then you can potentially have a loss of this amount at the resistance levels outlined in red. Finally, profit and loss calculations are based on a one-lot trading volume. So, why is the NFP important for the financial markets? The non-farm payrolls report is the release of data on US jobs growth over the previous month, and it's published by the Bureau of Labor Statistics, usually on the first Friday of the month following the data. It is the most eagerly awaited monthly data by world markets. Morning trading volumes are usually quite thin in European markets on the day of the release, as they await the afternoon release time. The headline number in the report gives the number of jobs that the US economy has gained or lost over the previous month. A more important number for the markets, however, is the difference between the actual change and the consensus of estimates by analysts and economists published in advance. The market reaction will depend on whether the published figure is above or below the consensus, and by how much. So over the past few years, non-farm payroll data has been very positive. But NFP estimates have failed to meet expectations over 6 times over the past year. However, last month's figures beat expectations, as I will explain further in a moment. As you can see here, the unemployment rate has significantly improved in recent years. The unemployment rate approached 8.5% during the financial crisis, but has fallen since. Since March 2017, the unemployment rate has dropped from 4.5% to its current rate of 3.7%. Average hourly earnings. This is important since an increase in the figures indicates a possible rise in inflation and in the value of the dollar, while a decrease in AHE tends to push the dollar down. Month-on-month average hourly earnings were 0.2% in October, and on a year-on-year basis it was 3.1%. So the NFP release comes together with the unemployment rate indicator on the first Friday of every month. When this is due, the trading week is a range-bound one for the forex market, and after the release, traders start positioning for the next time the Fed meets to see how monetary policy changes in the meantime and how to react. When the actual number differs from the forecasted one, the market travels. Usually, traders take positions for the NFP in advance by looking for clues from other economic data like the ADP jobs report or private payrolls. It's believed that private payrolls and the NFP data are linked in a correlated fashion, but this isn't always the case. The unemployment rate is part of the Fed's decision-making process to move on rates, too. As a rule of thumb, a lower unemployment rate is better for the economy, as jobs are created, and this could result in the Fed hiking rates. Higher rates lead to a higher dollar. And since there is no such thing as full employment in an economy, by the time the unemployment rate has fallen to below 4%, a labour shortage has already appeared. Experienced traders know this. Forex trading is about anticipating what the central bank is going to do with interest rates at the next meeting. And the NFP is the perfect economic release to position on the right side of the market. The non-farm payrolls released on November the 2nd, 2018 showed that the US economy created 250,000 new jobs in October, better than the predicted estimate of 193,000 jobs. The jobless rate remained at 3.7%, in line with expectations. The US dollar index grew by 0.13% following the publication of the release on November the 2nd, before falling over the next week. On this graph, we can see the reaction of the market upon the release of last month's NFP report. As already discussed, the unemployment rate was in line with expectations, and NFP produced better than expected figures. Average hourly earnings was at 0.2%, in line with expectations. So, the markets thus moved on the broadly positive results from the NFP, and as a result, the dollar grew in value, but then fell in the following days, as we can see here. The dollar index, as I just said, grew by 0.13%, but as you can see on the graph, it reversed and dropped by some 0.78% over the following week. The markets were not dramatically affected by last month's NFP, unemployment rate figures and average hourly earnings, as the markets have already factored in the interest rate rise in December. Another exceptional political factor to bear in mind is that even as the NFP figures were being released, investors had one eye on the US midterm elections, which took place on November the 6th, which was, as you can see, during the period when the greenback fell. As far as the euro-dollar is concerned, by close of business on November the 2nd, the currency pair was down. It's worth keeping in mind that the euro has been weaker in recent months due to poorer economic performance and EU problems with Italy and Brexit. But there was a reversal in the days following, as you can see, by some 0.88%, since the euro climbed slightly and the dollar retreated. The thing to remember is that the dollar is often volatile on the day of the NFP, but that the NFP can also represent a good trading opportunity. So what can we expect from this week's report? Well, economists expect that the NFP will record that 200,000 new jobs were created in November, and that the unemployment rate will remain at 3.7%. Traders would also be advised to keep an eye on the average hourly earnings figures, If they are above expectations, it may push the dollar higher. Average hourly earnings are considered a sign that inflation will rise, and if inflation rises, there is a greater chance of interest rate hikes in the future. A fourth rate hike this year is highly likely to take place on December the 19th, with CME Group estimating the probability of such a rise at 88.7%. Rate hikes are opposed by President Trump, who favors lower rates, but it seems that some traders believe his constant criticism of Fed officials has changed their language, although 3 rate hikes next year still seems likely. In recent months, the dollar has been trading in higher ranges against a basket of other currencies, and the greenback continues to be powered by a strong economy and the prospect of gradual interest rate hikes next year. So it is certain that reports like the NFP can have a major influence on the greenback and the financial markets. Another factor to bear in mind, by the way, if you are trading the dollar, is the trade war. The dollar has functioned as a safe haven currency, as many investors believe the US is in a better position to ride out a trade war than other countries. So, if you are looking to trade the NFP as a short to medium term move, you should consider that as trade war tensions increase, the dollar tends to increase in value against other currencies. On the other hand, if you believe there will be an end to the trade war sooner rather than later, this scenario would likely influence the dollar downward against other currencies. However, the trade war is an important factor, but not the only one to consider when trading the dollar. Of course, we at ForTrade will be following any developments that affect the markets very closely. So please do get in touch with the Senior Account Manager if you have any questions or want to take advantage of the trading opportunities that this event will present. Until next time, goodbye, and please join us at ForTrade again soon.